Hey small business owners, my name is Andrew Bloom and I am a bookkeeper for small businesses as well as a PhD student studying business and strategy. Managing your books might not be the most exciting part of running your business, but it is one of the most important things you need to do to stay financially healthy and avoid any costly mistakes. So if you ever found yourself wondering, how do I track my business income and expenses accurately? Why doesn't my bank balance match my records? Or what exactly is a debit and a credit and why do they even matter? Then this video is for you. Today we're covering Bookkeeping 101, your complete beginner's guide to understanding and managing your business finances. We'll go step by step through what double entry accounting is. This is the foundational accounting model that the majority of businesses use. We'll explain what it is and why it matters. Debits and credits, how your transactions are recorded depend on whether they increase or decrease an account, and the balancing of debits and credits is the foundation of how double entry accounting works. The chart of accounts, how you organize your accounting system specific to your business depends on this list of accounts and account types. Common bookkeeping transactions. So these are the real world examples of what you would actually record on a spreadsheet or in your bookkeeping software. We'll use QuickBooks as an example to show you how this is done. Bank reconciliation. The reconciliation process helps ensure that your records are accurate. And financial reports. These are the financial statements that tell you how your business is performing and how you can use this information to make strategic decisions in your company. I recommend that you stick around to the end because I'll also share some expert tips to help you avoid common bookkeeping mistakes that could cost you money, time, and stress. Alright, let's get started. The first thing every business owner should understand about bookkeeping is double entry accounting. This is the system that keeps your books balanced and ensures that every financial transaction is recorded properly. Double entry accounting is built on the accounting equation, which states that assets equals liabilities plus equity. This equation represents the financial position of a business at any given time, ensuring that everything the business owns, its assets, is funded either by what it owes, its liabilities, or by the owner's investment and profit, its equity. Like any algebra equation, you can change this equation around so that equity, a business's profit and owner investment, can equal its assets, what the business owns, minus liabilities, what the business owes. To keep the accounting equation balanced, every financial transaction must be recorded in at least one of two accounts. This is represented by what's known as a T-chart, because it looks like a T. On the left side of the accounts, we have debits, which increase assets and expenses, but decrease liabilities and equity. And we have credits, the right side of accounts, which increase liabilities, equity, and revenue, but decrease assets and expenses. It's important to note that on a basic level, assets always record an increase in its accounts as a debit, and that liabilities and equity always increase its accounts as a credit. So when you debit an asset account, like a business checking account, it increases in value. And when you credit a liability account, like a loan from a bank, it increases its value as well. For example, let's say there's a coffee shop, Morning Brew Cafe, which one morning sells $100 worth of coffee. So it records a debit to the cash account by $100 because cash is an asset and it's increasing the account, and it credits the sales revenue account by $100 because revenue increases equity. If the same coffee shop purchases $50 of coffee beans, you'd see a debit, an increase in inventory by $50 because inventory is an asset account, and it credits a cash account, it decreases it by $50, which is a reduction in the asset. This system ensures that every dollar going in or out is accounted for in at least two places. Without double entry accounting, it's easy to lose track of transactions, which can lead to mistakes in financial reports or even lead you to trouble at tax time. So debits and credits, what do they really mean? Let's dive a bit further into debits and credits since it's one of the most confusing parts of bookkeeping. But once you get the hang of it, it makes perfect sense, and as a bookkeeper, it's a very satisfying feeling to see accounts balanced. So let's go back to our example of Morning Brew Cafe. If you sell $500 worth of coffee, this would be a debit, an increase to the cash account by $500 since they made $500, and a credit to the revenue account, an increase to the revenue account by $500 because that revenue account is an equity account. But wait, Andrew, you might say, how can there be a balance when two different accounts both increase? Let's recall the nature of equity and liability accounts, which increase with credits. It all goes back to the accounting equation. Assets equals liabilities plus equity. Everything needs a balance. Revenue accounts belong to the equity section of the accounting equation. When a business earns revenue, it increases the company's value, meaning it increases its equity. Since equity increases with credits, revenue is always recorded as a credit entry. Knowing how this balance works, of the equation, knowing how debits and credits work, help ensure that your books stay balanced and accurate. And this leads us to talking about the chart of accounts. Your chart of accounts is the foundation of your bookkeeping system. It's a structured list of all the categories that you'll use to track your business's finances. So for Morning Brew Cafe, the chart of accounts might look like this. It could have assets accounts of cash, coffee machines, and furniture. It could have liability accounts such as business loans and vendor payments that are due, as well as equity accounts, which could be owner's investments, the money that the owner put into the business, as well as the retained earnings from the profit made by the business, and revenue accounts such as coffee sales, the pastry sales, and merchandise sales, and expenses, which would be something like rent, coffee beans, wages, utilities, and marketing. These are all the different categories that record the debits and credits. For example, if Morning Brew Cafe buys $500 worth of new coffee beans, it would be recorded under expenses. If they purchase a new espresso machine for $3,000, it would go under assets because it's a long-term investment. When you use a software like QuickBooks, all this debit and credit balancing is going on in the background, and your chart of accounts helps set up that back end. You simply record your expenses as either bills or expenses, and you record your income through methods like invoices and sales receipts. Other transactions like bank deposits, your personal investments into the business, and loans can be recorded, but be sure they are categorized in the right kind of account. Overall, a well-organized chart of accounts helps you easily track expenses, revenue, and profit, so you always know how your business is performing. Okay, by now take a deep breath. I know all this can feel really overwhelming. If keeping track of debits, credits, and transactions isn't really your thing, don't worry. You don't have to do this alone. In fact, you don't have to do this at all. This is where hiring a bookkeeper comes in handy. Personally, I offer remote bookkeeping services across the US designed for small business owners and solopreneurs like yourself. You are more than welcome to visit my website at profitlogic.com, where you can book a free discovery call and we can discuss a unique bookkeeping service to help you keep your finances organized so that you can focus on growing your business and not worrying whether you're balancing your accounts right. I would happily do this for you. All right, let's keep moving forward. Next, let's discuss another important bookkeeping activity, bank reconciliation. Bank reconciliation is the process of comparing a business's accounting records with its bank statement to ensure that both sets of records are accurate and match. This is important because discrepancies can arise due to outstanding checks, bank fees, deposit delays, errors, or even fraudulent transactions. So why is bank reconciliation important? Number one, it ensures accuracy. It helps identify missing, duplicate, or incorrect transactions. Number two, it can detect fraud and errors. Unrecognized charges or unauthorized withdrawals can be spotted easily. Number three, it improves cash flow management, so it can give you a true picture of what cash is available. And number four, it helps with tax compliance, which will ensure that all transactions are properly recorded for tax reporting. Imagine Morning Brew Cafe checks its books and sees $5,000 in the bank account, but the actual bank statement says $4,750. That's a $250 difference. Where did that money go? This is where bank reconciliation comes in. By comparing your accounting records with your bank statements, you can catch whether there's a missing record of $250 or if there is money in transit that hasn't reached the account yet. Reconciling your accounts every month keeps your books accurate and gives you confidence in your numbers. So let's talk about financial reports. This is probably one of the biggest benefits of having up-to-date books each month. Financial reports are essential documents that summarize a business's financial performance and position over a specific period of time. They provide insights into revenue, expenses, assets, liabilities, and overall profitability, helping business owners make informed decisions. The three most important financial reports are number one, the profit and loss statement, also known as the income statement. This shows revenue, expenses, and net profit or loss over a period of time, usually on a monthly or annual basis. For example, Morning Brew Cafe can review its P&L statement and see that it made $10,000 in sales, spent $6,000 on rent, wages, and supplies, and had a net profit of $4,000 for the month of February. All right, next report, the balance sheet. This provides a snapshot of a business's financial health at a specific date. It lists assets like your cash, equipment, inventory, its liabilities such as loans, unpaid bills, and equity, owner's investment, and any retained earnings. So for example, Morning Brew Cafe's balance sheet on the 28th of February shows $20,000 in assets, $8,000 in liability, and $12,000 in equity. Again, this is the accounting equation at play, meaning that the owner has built value in the business. And lastly, there's the cash flow statement. This tracks how money moves in and out of a business, ensuring that there's enough cash to cover expenses. It categorizes cash flow into operational activities such as day-to-day transactions, investing activities like buying and selling assets, and financing activities such as loans and owner withdrawals. For example, if Morning Brew Cafe sells a lot of coffee but struggles to pay bills on time, that cash flow statement may reveal that too much cash is tied up in its inventory purchases. So regularly reviewing financial reports helps business owners understand profitability, liquidity, and overall financial health, allowing them to make data-driven decisions and plan for growth. All right, you did it. I know accounting is not everyone's favorite subject, but I hope by now you have a basic understanding of how bookkeeping works and why it's important for running a successful business. If you found any of this helpful, be sure to like, subscribe, and check out my website, profitlogic.com, for any additional bookkeeping information and services. I wish you nothing but the best of luck with your bookkeeping and your business. I'll see you next time.